I believe physical gold will go higher, but I believe shares in general will outperform it. The leverage now will give larger percentage gains to the companies that mine it versus the physical bullion. The change for me, and you would know this as you've spoken to me, as you said, since 2020, is I used to say to about 3 months ago, owning silver was like kissing your sister. You'll remember that line more than once. I now believe, and 3 months ago chose that silver now is in the same ballpark in gold. In fact, I think it's preparing to outperform gold for the next several months. So I still think there's a lot of gains potentially in the physical prices of metals, but I think the companies that look for them, mine it, and also explore will actually offer better leverage opportunities than the physical metals themselves.
Silver is currently outperforming gold in this cycle. This divergence signals growing interest in the precious metals sector. Moreover, traditional leadership by gold is now being challenged as silver increasingly captures investor attention. Silver prices climbed above $39 an ounce Monday morning, touching their highest level since February 2012, amid renewed investor interest and robust industrial demand. The precious metal's upward trajectory comes as gold also holds near record levels, underscoring persistent concerns over inflation, potential Federal Reserve easing, and resilient manufacturing demand for metals. Seasoned contrarian investor Peter Grandich notes a shift in his outlook on silver, now expecting it to outperform gold in the near term. Given silver's smaller market size, even modest interest could drive major price gains. He compares current broad market enthusiasm to late-stage bubbles. Peter Grandich recalls selling general equities in 2021 to buy physical gold, which outperformed stocks and bonds 4-1. While he still sees gold rising, he expects mining shares to outperform due to stronger profits and growing investor interest. According to data shared by Barchart, GLD has delivered a cumulative return of approximately 596.58%, surpassing the 556.83% gain posted by the S&P 500 ETF over the same period. While discussing miners, Grandich highlights that GDX has outperformed gold by nearly 20% year-to-date, suggesting the sector is making up for lost time. He sees the mining industry in its best shape in over 5 years, with renewed interest and M&A activity. Gold mining equities, as represented by the NYSE Arca Gold Miners Index, once again managed to post a gain despite gold's flat performance and the broader equities' strong recovery. In both 2023 and 2024, whenever gold prices drifted sideways without much momentum, gold equities tended to experience sharp declines. This downturn also corresponded with declining investor interest in gold, as evidenced by outflows out of the gold bullion ETFs. Before we dive into Peter Grandich's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
The metals have actually done better. You know, you remember now in 2021, I have to bring it up to answer your question. I
Sure.
made it. I made a move that maybe 1 in 10,000 people did. I sold my general equities to own physical gold on the belief that gold itself would outperform both stocks and bonds. And it did by a factor of 4. Then I went into the major producers because of the prices going so high that they have made such great free cash flow. I think that's going to continue for them. Now, of course, I focused on to the lower end of the more risky, the most riskiest side of that, and that's junior resource stocks. I feel much more comfortable owning mining shares at this point in time than I do a high-flying technology stock. I can assure you there aren't many other people that have that same opinion, but I sit comfortable with that because I have been a contrarian my whole life. I believe physical gold will go higher, but I believe shares in general will outperform it. The leverage now from free cash flow will give larger percentage gains to the companies that mine it versus the physical bullion. I still think it's going higher. The change for me, and you would know this as you've spoken to me, as you said, since 2020, is I used to say to about 3 months ago, owning silver was like kissing your sister. You'll remember that line more than once. I now believe, and 3 months ago chose that silver now is in the same ballpark in gold. In fact, I think it's preparing to outperform gold for the next several months. So I still think there's a lot of gains potentially in the physical prices of metals, but I think the companies that look for them, mine it, and also explore will actually offer better leverage opportunities than the physical metals themselves. I believe physical gold will go higher, but I believe shares in general will outperform it. The leverage now from free cash flow will give larger percentage gains to the companies that mine it versus the physical bullion. I still think it's going higher. The change for me, and you would know this as you've spoken to me, as you said, since 2020 is I used to say to about 3 months ago, owning silver was like kissing your sister. You'll remember that line more than once. I now believe, and 3 months ago chose that silver now is in the same ballpark in gold. In fact, I think it's preparing to outperform gold for the next several months. So I still think there's a lot of gains potentially in the physical prices of metals, but I think the companies that look for them, mine it, and also explore will actually offer better leverage opportunities than the physical metals themselves. It's just of an interest that hasn't been there. You know, there are estimates, and I don't think there's any of this is official. This has just been experts speaking about it over years, Dave. But there's an estimate that 20 or 30 years ago, as much as 2 to 4% of the average American portfolio was in the metals. Now people estimate it at half of 1%. So if both parties are somewhat right, and we just get a doubling of interest from 0.5% to 1%, that's going to move markets, especially silver, which is only 1/5 the size of the gold market. That's another reason why I like the silver at this point in time as well. We're witnessing things we haven't seen in several years in the metals and mining. The interest that had disappeared, the amount of financings, the mergers and acquisitions that are occurring and all. I would argue that the general metals and mining industry today, as you and I speak, is in its best shape in over 5 years, maybe even back to the last great run in 2010 or 11. Yes, that chart is meaningful, but I just also think that there's a bigger opportunity for the shares now versus the physical underlying metals. And that's, of course, why I focus that way as well. I have a nickname called Riverboat Pete. So anybody that's a true gambler, and by the way, speculating and gambling is the same thing. Wall Street just created the word speculating so they
Okay.
don't have to say gambling. But the bottom line is I'm one that likes to take a risk. I'm willing to lose a part or all of my principal. I just did. I had my worst loss ever in what I thought a few years ago was one of the best possible mining stocks. So there is substantial risk and potential loss in this. But overall,
Yeah.
particularly if you stay with indexes like the GDX or the GDXJ, I still think they will do as well, if not better, than the stock market, at least for the balance of this year and into 2026.
Regarding the U.S. debt, Peter Grandich warns a reckoning is near, with rising risks of default or hyperinflation. He doubts growth alone can fix the crisis without runaway inflation. Social unrest and failed treasury auctions could follow. Only term limits and a balanced budget could help, but he sees no political will. On July 4th, President Trump signed his big, beautiful domestic policy bill, enacting a new wave of tax cuts estimated to add $3 trillion to $4 trillion to the national debt. While the national debt may be hard to conceptualize, economists say its explosive growth has the potential to have major impacts on the economy that will be felt even by individuals. Increased inflation is also a likely facet of a U.S. economy with an increasing national debt. The same Yale Budget Lab study noted that a deficit increase of 1% of GDP would raise inflation to the degree that, after 5 years, a household would lose $300 to $1,250 in purchasing power in 2024 dollars. However, Grandich expects the stock market to end 2025 flat, but warns of a possible melt-up if Trump influences the Fed to cut rates early. A surprise rate cut could trigger a final surge, especially with institutions currently short and retail investors driving prices. He sees signs of a late-cycle top, not a new bull market. Let's get back to the interview.
Well, it's only going to get worse. But Donald Trump, and I do believe he believes this wholeheartedly, by the way, he believes he can grow ourselves out of this terrible debt and deficit mess. The problem is, I don't think we could ever have enough growth without runaway inflation, which would negate a lot of that growth, in order to service and pay down any debt. I don't think in any lifetime, mine or yours, you're going to see any part of the national debt paid off. The question now that people are coming to is, are we getting to the point where we're going to have structural problems paying the interest? One of the reasons also that Trump wants to see an immediate cut in interest rates, and by a lot, is we have almost $10 trillion that needs to be refinanced in the coming months in the Treasury market. It would mean a lot if they could do that to 1 or 2% below where they're currently at. That's another reason for his wanting to see cutting interest rates. But what I think the Ray Dalias and others that continue to point out is we are really getting out of hand. We cannot run $2 to $3 trillion deficits and expect to be able to provide government services in the same manner that people were used to 10 or 20 years ago. We just won't. And the other problem that we're running into, and this plays into why I believe he's made a mistake on the trade war with a big stick, we're so dependent on foreign capital to service our debt. And I don't think we're winning any friends in this trade war. In fact, I think we're losing if we had some friends, Canada being perhaps one of the best friends that we ever had. And therefore, I think short term it looks good, but longer term it's causing even a bigger problem. No, I don't think there's a way out of this. I think there's a day of reckoning. We're closer to that day of reckoning now than any other time in my career. I think if it ever got, there's a great movie out from the early 1980s if people want to have a possibility of what it can look like. It was called Rollover. And those that have been around a long time will know what I'm talking about. And it painted just that, what will transpire. I'll tell you the other issue that concerns me greatly. Ever since Donald Trump came down that escalator to announce his running for president, there's a group of people who've grown very, very hatred, worse than hatred, against him. It's playing out now literally in the streets of the United States. I suspect that civil unrest is going to get worse, not better. And if I'm correct about that, that will impact all the other things that we talk about economically, politics, and what have you. And so therefore, I believe that Donald Trump is trying to turn the economy enough to where he can say, see, I'm really doing the right thing for most people. But there's a group out there that truly, really wants to see that he's wrong and will do anything to make it wrong. And that's the battle that's still in front of us. So just so you know, David, I don't sell anything that's going to benefit by saying that. So, like if I sold gold or cabins in the woods or firearms, you can understand someone saying that. But I am very, very concerned now that America's probably gotten to the point where it's more divided now than any other time, other than perhaps our Civil War, and it's getting worse, not better. The stock market has been down and up a few percentage points, something which I felt that by the end of the year, that's how it was going to end, almost as it started the year, a few percentage points either way. I do think that some of those, as you see in that report there, some of the concerns are getting worse, the debt crisis, the retirement crisis. Something that a year or so ago, not many people were speaking about when I did, but now has moved to the forefront, and that's the infrastructure and natural disaster crisis, these horrific problems that we've seen now, loss of life, great loss of properties, aided by natural disasters, but because of poor infrastructure, is also coming out to the forefront now. So I feel pretty good on the stance that we take. I don't see anything to have to change other than this. I'm really concerned about Trump posting today, as you and I speak, spending time talking about how well crypto's doing and how well Nevada and some other technology stocks are doing. I think the president of the United States has bigger concerns and should be more focused on other things. But he is somebody that has simply bet the ranch of his success based on the performance of the stock market. And why I bring that up is if he's able to force, which I think he's trying his best to do, a change in the Fed governor earlier than his term, he certainly is going to appoint somebody that's basically assured to start lowering interest rates, whether they're deserving to be lowered or not. And that could be the last kick to the stock market and kind of have a melt up. So that's not something I was thinking of at the beginning of the year, but now in the way that I've seen he's acting, and it's really clear that that's what he's hoping. There's even rumors now that Powell's going to step down and all. That could be the last ingredient to what would be called a melt up in the stock market and maybe the last hoorah. I will also make note to you that, not counting junior resource stocks, but some of the biggest gains now in the U.S. equity markets are in very, very low price stocks with huge gains. And those are the type of things that happen at the end of equity cycles. I just think the melt up will just be the last hurrah. It doesn't necessarily need a lot of more liquidity.
Okay.
I do think that if we start to see interest rates cut, that will be viewed by people as just another reason to own stocks and own them more aggressively. Know this, and this is interesting. I've been at this 41 years. At this point in time, institutional investors have been basically net sellers of the stock market, while the public has been net major buyers. Normally, they are right, the institutions, and the public is wrong. If we do get a surprise and start seeing lower interest rates and the market starts to move, there's a lot of people short on the institutional side of the market, and that's how you can get your melt up if it's to occur.
Historical data from previous bull markets suggests that further gains for silver are achievable once gold reaches new heights. Current performance patterns mirror those seen in 1972, offering a strong case for continued upward momentum. As markets flirt with euphoria and debt burdens mount, will policymakers act before the reckoning arrives, or will short-term gains blind us to long-term consequences? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.